Good afternoon. You're watching the newsroom right here on ET Now. I'm Ajaya Sharma, and the markets are giving up. All the morning gains, Nifty and Bank Nifty have flattened out. In fact, let's pull up the broader markets also. You'll see some amount of profit taking there as well. Advanced decline ratios seem to be suggesting that at least some part of the market is doing okay. Not outright rout like we saw day before yesterday, but at least weakness is setting in. Some commentary coming on your ticker right now, commentary of the new Prime Minister of United Kingdom saying that she will be taking all the possible steps along with the Bank of England to ensure economic stability in the country. But yesterday you did see Bank of England's decision spread some amount of cheer, calming down of yields. Siddhartha Bothra is here to talk more about markets and investing and how to navigate this environment. Siddhartha Bothra is a fund manager at Motilal Oswal AMC. Siddhartha, good chatting after a long while. How are you looking and reading at indicators? Or let me put it this way. Do you see the dollar index and the US bond yield peaking out yesterday's move, or do you think they can still go back?
Good afternoon, Ajay, and thanks for having me on the show. Uh, my sense is these are macro issues, and I feel we'll probably see extremes this time too. Like if you look at the last 10 years, no one would have imagined, the kind of excesses we saw on the liquidity side. I think in the same way, on the way towards tightening, our sense is that you will probably see some excesses happening on that side as well. So, that's how I think about it.
How are you building in the macro risks in your portfolio strategy?
So we are not much of a top down kind of investors. We are more bottom up investors. So many of these macro risks that you see are largely the systematic risk. To that extent, I think the systematic risk always remains. At any stage in the market, there's one thing or the other on the macro side which is impacting. And I think it's fair to say that over the next few years, this would be a key macro risk. So I think some of the ways that you try to incorporate it while you are bottom up, but some of the ways you try to incorporate it is by looking at companies which have on a good pricing power, because in an environment where inflation is going to be high, where interest rates are moving up. So if you are in businesses where these are necessities, where the companies have good pricing powers, that gives you some help in kind of fighting back with these macro issues that you're facing. Similarly, when you look at companies, which are more domestic focused, or could in some way end up benefiting from these environment. So I think these are some of the ways you try to safeguard against these. The other being in this environment, actually looking for companies where growth is higher, from the broader normal growth that you're seeing across most of the sectors. So I think if you are companies which are growing much faster, that also in some way gives you some kind of a hedge against these risks.
Siddharth, how are you looking at the numbers, the earnings? For example, Nifty at 17,000 odd. What kind of FY24 or 25 number do you have in mind? And do you think that number also may have downside risk given the slowdown issues hitting the world? We would also come under pressure.
So if you look at FY22 and this year also, the last 6-9 months have been a period where we have essentially seen most of the analysts, kind of increase their estimates. So we have been in an increasing environment where, most of the estimates have been moving up. And to my mind, in the near term, I don't see much risk, but there's, if the situation globally, the macro issues that you see actually worsens further, then the demand could be a issue for especially companies which are more exposed towards exports, or sectors which get more impacted by these global issues. So maybe towards the fourth quarter or thereon, you could see some of pressure coming back on earnings, and again probably this cycle of upgrades kind of stalling. But I think near term, I think the earnings outlook continues to look strong. Some of the contributors which are contributing to it, I mean, some of the sectors, whether you look at banking, whether you look at some of the other sectors where the base has been low on the consumer side, and now growth's coming back. So they continue to look strong, and so I think the fourth quarter onwards, if the macro were to worsen, then we may see a risk.
Mm-hmm. Okay, give us an idea what kind of earnings growth does your portfolio throw up, say 4 to 16 quarters far out, just to understand next 2 to 3 years the profile of, on average, the earnings which your portfolio will be showing up in your estimate.
Sure, I can give you a sense as to essentially what we try and do is look for companies which are essentially growing faster than the market, or there are some sectors where growth may not be higher, but it's very longevated and stable growth. So as a mix, I think our earnings growth over the next 2 years, the CAGR for the portfolios I manage, we try and keep it upwards of say in the band of upwards of 20 to 25%. And while these numbers are obviously dynamic, because we already seeing so much of volatility around it, but that's our endeavor, and that's what we try and do. So some of the contributors and why we think that the earnings growth for our portfolio is strong is almost 1/3, or say 33-34% of our more than that of our fund is in financials, and that's a sector where we think that the earnings growth will be very strong. Similarly, autos is also one of the larger components in our portfolio. Here again, the earnings growth coming back very strongly, because we've seen 1-2 years where the normal production was impacted. There were so many other issues which were leading to the full year numbers not being normal. So I think part of it is base, but otherwise also growth is coming back strongly. So I think in the upwards of 20-25% band is where we are looking at the next 8 quarters or next 2 years CAGR for our portfolio.
Oh, that's good to know. At least see, we can't control the price movement of the stock or the market movement, but we can do a lot about what kind of companies we get in. And you have clearly crafted out a very high growth portfolio in terms of earnings. Talk to us about what is the average valuation for this kind of a growth offering, earnings growth offering. What is the valuation your portfolio is trading at right now?
So I think, just to give you another sense, like I talked about 2 sectors where, we have large weights and where earnings growth likely to be strong. We also have some of the, on the mid and small side, some companies where, again, earnings growth have been very, very strong. Like, one of our holdings is Coal India, where, the earnings growth has been very strong this year. And when you look at a 2-year CAGR, that's very strong. And the valuations there, or some similar companies, are very inexpensive. So on the whole, we try and look at a portfolio where our PEG ratios are, say, between 1.3 to 1.4 times. And, as I speak to you, I think that's the band within which both our growth rates and, the PEG is where we are trying to keep the portfolio around.
Right. What are your thoughts on the kind of valuations mid cap and small cap end of the market is trading at right now?
So if you see, I think over the last 1 year plus, the mid and small cap as a overall sector has seen correction, and the kind of overvaluations which were present there versus, say, the large caps is corrected to a large extent. But given the volatile environment we are in, I still feel that when you look at large caps, uh, valuations in many of the spots, they are still way too attractive. So there is a little bit of a large cap bias in our portfolio, because we feel that not only that the environment is volatile, also I think the large cap valuations, though now the difference between large cap and mid cap and small cap has largely decimated, and in many cases, when you look like to like, the mid and small caps have also started looking attractive, but we continue to have a bias towards large cap, given that valuations there is much more attractive, given the kind of companies you can buy there, the stability that some of these large caps provide, and so on.
All right, Siddharth, thanks very much for your time. That was Siddhartha Bothra talking about the way they are approaching investing in this kind of a overall global turmoil.